Everyone, so this video is an interesting video I found by William Ackman, um, who provides a very clear um, lessons on what to know about finance and everything. It's not about finance, and he, phrased this video as everything you need to know about finance and investing on under an hour. And I would just summarize some places that if you are curious about finance or you want to learn about some of the basic specificities of finance and how to apply that in your business, I think I'll help clarify some of the things that he has mentioned in this video. So let's do it. And by the way, welcome to this YouTube channel. I talk about finance, emerging markets, as well as everything that has to do with building a successful business and also learning how to be an entrepreneur. So we'll just go at it, and I'll give a brief description of what each of what he's saying and trying to clarify that.
Hi, I'm Bill Ackman. I'm the CEO of Pershing Square Capital Management, and I'm here today to talk to you about everything you need to know about finance and investing. And I'm going to get it done in an hour, and you'll be ready to go. So let's begin. In order for you to get a better sense of finance and some of the basic terms associated with a business and investing in a business, I'm going to use the example of a lemonade stand. We're going to go into business together. We're going to open up lemonade stand. So the reason why I'm using the example of a lemonade stand is a very simple way to understand the basics of a business, how to understand how a business works, how a business generates profits, what's involved in raising capital to start a company, what you do when you're ready to decide to monetize your investment or take some money off the table. You'll be able to understand each of these concepts through the very simple lens of a small startup business like a lemonade stand. We're going to go into business together. We're going to start a company, and we're going to start a lemonade stand. And now I don't have any money today, so I'm going to have to raise money from investors to launch the business. So how am I going to do that? Well, I'm going to form a corporation. It's a little filing that you make with the state. And
so just to get in here, founding a corporation, for the most part, especially when I talk to people who are trying to start a business, there's a lot of ambiguity here. And just a lot of fear and anxiety when it comes to actually forming and launching a business. But there are some really interesting middlemen that can actually help you kind of just launch a company for you. And it's pretty straightforward. You can actually pay a few $100s and they can actually help you do that. And I think this is a struggle that most people face. But I do think that it can really much be simpler than you think. And so what I used Northwestern agents. It's based. The literal, I was recommended by a friend. Just check that again. Yeah, it's recommended by a friend, and literally I just pay 100 and a few dollars beyond that, and it actually help you make sure that your company is always registered, and they also help you to make sure that you file your taxes and all that, right? So don't get intimidated by this. I think it's very straightforward. So it's called Northwest Registered Agent. That's what I use, and I think there are many others out there.
Come up with a name for your business. We'll call it Bill's Lemonade Stand. And we're going to raise money from outside investors. We need a little money to get started. So we're going to start our business with 1,000 shares of stock. We just made up that number. And we're going to sell 500 shares more for $1 each to an investor. The investor is going to put up $500. We're going to put up the name and the idea. We're going to have 1,000 shares. He's going to have 500 shares. He's going to own a third of the business for his $500. So what's our business worth at the start? Well, it's worth $1,500. We have $500 in the bank plus $1,000 because I came up with the idea for the company. Now I need a little more than $500. So what am I going to do? I'm going to borrow some money. I'm going to borrow from a friend, and he's going to lend me $250. And we're going to pay him 10% interest a year for that loan. Now, why do we borrow money instead of just selling more stock? Well, by borrowing money, we keep more of the stock for ourselves. So if the business is successful, we're going to end up with a bigger percentage of the profits.
So this is very critical because most of the time people try to ask what type of investment vehicle is more sufficient for them, and I think it solely depends on your it always depends on the industry, by the way. Some industries have a high internal rate of return, which just means like you can get your return on invested capital in a shorter time frame, and some actually takes longer. So depending on the structure of how those companies, your company is being set up and how you intend to set up the company, you can actually figure out of investment vehicle that actually suits that the time it takes for the capital to be returned, right? So if you think the return invested capital can take shorter, you can't just do borrowing, because at the end of the day, you can pay back the person with the interest, the person who you borrowed from, or the creditor, and you keep back some of your shares in the stock, right? So you still have ownership of your business. Whereas if you are seeing this company as a long-term thing that you also want experts to get into the business, you can actually think of giving equity, which is like the first example of which you mentioned. So it just depends. You can also do a hybrid where you borrow money, then over time it turns into an equity. So equity just means that they own a share of the company. So you can actually do that, and with time, you get they own the share of the company, but they're in the business for the long term. So that's another option that you can be thinking about and applying that as well.
So now we're going to take a look at what the business looks like on a piece of paper. We're going to look at something called a balance sheet. And the balance sheet tells you where the company stands, what your assets are, what your liabilities are, and what your net worth or shareholders' equity is. So you take your assets. In this case, we've raised $500 in exchange.
So one thing that is just important here is that there's three types of very important financial statements that it looks intimidating, but it's not. It's basically just three different ways of looking at how the company is doing, the health of the company. One, this balance sheet, it shows a snapshot in history of what the company owns and what the company owes, right? And pretty much you can get this snapshot in 6 months or in 3 months or in a year. And so it can be an annual thing, it can be a biannual, or it can be a quarterly thing, right? So the goal is just, it gives a sense of what you own or you don't, or what you owe and what you don't, and what you own, right? So and this is just a snapshot, because companies move, that it's considered as a living, breathing thing, right? Two other ones that are very critical. So you have the income statement, which shows basically probably a snapshot, maybe for a shorter time frame. So you can have an income statement for like the month or even the week. It just depends on how much you're selling and how much you're buying in. Literally, that's what an income statement is. It shows what comes into the business in terms of sales and what goes out in terms of cost of goods sold, right? How much you put in to literally build that product, right? Or to design that product. And that's what it's called, cost of goods sold. You might have, other costs associated with that, of cost of goods sold, that might be factored in as a result of like inventory or, accounts payable and all that. But for the most part, it comes with, just on the very basic level, it just comes with the value, the difference between sales and the cost of goods sold. Then the last one is called the cash flow statement, and that is more transient. So cash flow statement is actually what most investors look at, because it actually shows the true health of the company. And that's what makes sense, because cash flow statements measures their income statement against the balance sheet to actually show what's the free cash flow of the company. So what the company actually has, because if you think of companies like Uber and Amazon, they actually are losing money based on the fact that even though they make sales, most of the investment, which is liabilities, but they'll become assets over time, are negative, right? So the liabilities overweigh the assets. And even though the revenues are high, if you match that up with, or you put that against the balance sheet, the overall negative in cash flow, because most of the cash flows are reinvested back into the business. So free cash flow is it's a real source of understanding the the cash, it's cash management, the flow of cash within the company. And to some degree, investors want to know how much they can get the money back for sure. So that's why I look at the cash flow statements. Each of these statements have a different reason and a different time to use. But for the most part, the ones that are really common to use are the cash flow statements as well as the income statement. And those two tend to show kind of day-to-day, but also like, kind of the heartbeat of the company, which for the most part, cash flow statements can show you that, right? Because at the end of the day, you want money, right? At the end, of the companies want to make money, right? So that's just pretty much the background of that. And this example is just trying to give, an example of balance sheet. And if you just look at these numbers, I think you see you have the cash flow statements, fixed assets. Fixed assets doesn't mean what are things that like a house or a store and all that. You don't have it. It's just a lemonade stand. There's no inventory because not yet. The goodwill is the $1,000 that came as a result of the investment that he made. So total assets is 150. The debt is 250 because it came from the friend he borrowed the money from. That's the liability. So share equity is $1,500, and 1,500 divided by 2.
For the $500, the person who put up the money.
Second, 1,500 divided by 2. No, 1,500 divided by, he just comes to $1 a share. So the $1 a share is just a number that he gave. It doesn't actually mean that's the fixed amount, $1 per share. You can say $2 a share. It just depends on on what makes sense for the most part. But that is reasonable.
Only got a third of the business. The other 2/3 is owned by us for starting the company. Well, that's $1,000 of goodwill for the business. We're borrowed $250. Well, we're going to owe $250. That's a liability. So we got $500 in cash from selling stock, $250 from raising debt, and we owe $250 loan. And we have a corporation that has, and you'll see on the chart, shareholders' equity of $1,500. So that's our starting point. Now let's keep moving.
So now
what do we need to do to start our company? Well, we need a lemonade stand. That's going to cost us about $300. That's called a fixed asset. Unlike a lemon or sugar or water, this is something that you, like a building, you buy and you build it. It wears out over time, but it's a fixed asset. And then you need some inventory. What do you need to make lemonade? Well, you need sugar, you need water, you need lemons, you need cups, you need little containers, and perhaps some napkins, and you need enough supplies to, let's say, have 50 gallons of lemonade in our start of our business. Now, 50 gallons gets us about 800 cups of lemonade, and we're ready to begin. Let's take a new look at the balance sheet. So now we spent $500. We only have $250 left in the bank, but our fixed assets are now $300. That's our lemonade stand. Our inventory is $200. Those are the supplies and things, the lemons that we need to make the lemonade. Goodwill hasn't changed at $1,000, so our total assets are $1,750. We still owe $250 to the person who lent us the money. Shareholder equity hasn't changed. So we haven't made any money. All we've done is we've taken cash and we've turned it into other assets that we're going to need to succeed in our lemonade stand business.
So
let's make some assumptions about how the business is going to do over time.
So I hope that makes sense. So pretty much he just took the money that, you in addition to money, the $500 was given, you use that to allocate these other forms of assets like the lemonade and all those things you need to make a lemonade, which falls back to, one is a fixed, it's a stand, then you have the inventory, which is a lemonade. Then from there, you're able to get an increase in assets, but it's just the cash you had, right? Plus the amount, the $500 that you invested. So literally $250 was from the friend. You can get $50 from the $500. That was taken as a result of the equity, which you don't have to pay at the same time. It gets to $300, the inventory is $200. So net to what you had previously. So you have $250 left because remember the other the person who would give you the equity in exchange of cash give you $500, right? So you use $300, $250 from the $500 to make the fixed assets. Then you took out, then So you took out 300. Let's say hypothetically you take out 300 from the 500, right? So you have 200 left, and you can use that 200 to make inventory. So you still have the 250, right? So, but anyway, it's just cash converted into assets, which pretty much that is how you have to grow the business, right? You have to convert it into the business.
Lemonade stand. Our inventory is $200. Those are the supplies and things. What we've done is we've taken cash and we've turned it into other assets that we're going to need to succeed in our lemonade stand business. So let's make some assumptions about how the business is going to do over time. We're going to assume we're going to sell 800 cups of lemonade a year. We're going to assume that each cup we can sell for $1, and it's going to cost us about $530 per year to start.
So this is the income statement. Income statement now, this is what I mentioned in the video, is figuring out how much you sell, but also how much the cost of goods sold. That what is the cost of making one unit, right? So pretty much you just
staff our lemonade stand. So now let's take a look at the income statement. So the income statement talks about the profitability, about the revenues that the business generated, what the expenses are, and what's left over for the owner of the company. So we've got one lemonade stand. We're selling 800 cups of lemonade at our stand, charging $1. So we're generating about $800 a year in revenue. And we're spending $200 on inventory. There's a line item here called COGS. Yep. That stands for cost of goods sold. We have depreciation because our lemonade stand gets a bit beat up over time and it wears out over 5 years, so it depreciates over 5 years. We've got our labor expense for people to actually pour the lemonade and collect cash from customers. And we have a profit, we have EBIT, and that's earnings before interest and taxes.
So just to clarify, so depreciation sometimes is an assumption, and on average, they always take 5 to 10 years. So like buildings is 10 years. I think other instruments can take 5 years. So literally what he did was based on the earlier value, the initial value of lemonade stand. If you had to sell that back in a year from now, you sell it back at 300 minus 60, right? Because that doesn't mean that it's wear and tear. So the actual value of the lemonade stand drops by 40. Literally by 300 minus 60, right? Just by 60, right? Because it's just the cost of depreciation, which is, and it's an assumption. It doesn't necessarily mean that's the exact value. The labor cost is either you hire someone. I think that's kind of ways, right? Can get for people to pour the level of time, but that you can still take that out, right? It's still just an assumption. About this, and when you think about this, I said, income statement can be a week, it can be a month, it can be quarterly, it can be biannually, it can also be an annual, which is what he suggested, and that's why everything is done per year. And first of all, like the cups sold, tentatively, he's saying that in the next year it's going to be 800 cups. And the revenue is $1 per 800. So
$10. It's kind of our pre-tax profit for the business. We didn't make very much money because you take that pre-tax profit of $10 and you compare it to our revenues, it's about a 1.3% margin. That's not a particularly high profit.
Yeah.
Now we've got to pay interest on our debts, and we have a loss of $15, and then we don't have any taxes, but at the end of the day, we still lose money.
So I'll just end it there for now, but I think the important thing is what he was trying to say was, one, how to find the right form of investment. He didn't necessarily say that, but I think from this video, you can induce that the 3 ways to get investment. You can actually get it from debt. You can actually get the money that you have saved. We can actually get it as an equity. So someone gives you money in exchange for a certain percentage of the company. That's one thing. The second thing is that business is all about figuring out how much cash you can bring in versus out. And from the last thing that he talked about, we focus on income statement. And income statement generating revenue as gains against the cost of making a product, right? The cost of creating a product. And finding that balance is what creates income statement. The balance sheet is where you actually do the assets and liabilities. So assets just means what you own. Liabilities just means what you owe, right? Or something that you have to pay forward. Like accounts payable, for example, is what people bought a service or bought something, and they have to pay another agent, right? And this works for like small mom and pop shops. It also works for big corporations. But for a lemonade stand as well, right? If you buy, let me say you buy the lemonade in advance, right? You have to pay them at some point. You'll be put on a balance sheet as accounts payable, right? So it's very the balance sheet is just a snapshot, and sometimes it doesn't necessarily reflect the amount of cash flow that comes into your business all because some of the payments are done at different time frames. So that's why the third financial statement, the cash flow statements, provide a much more of a time, a value of in terms of cash for that moment for every business, right? So that is why most of the time investors look at cash flow statements because they have actually, I don't say corrected, they've actually put in perspective the actual amount of cash that you have at your disposal at the very moment, and the balance of what is found in the balance sheet as a reflection of what's going on in the income statement. So they somehow adjust for that. And I think that's very important. So that's it from now. And moving forward, I'm going to address another video and the continuation of the video in another video. So thank you so much for watching, and I hope you enjoyed it. And I'm looking forward to working with you guys and clarifying more on, you know, the understanding finance now, how it applies to business, and moving forward to how to grow your business and much more. So thanks for watching this video, me, and I'm looking forward to seeing the next video. Take care. Bye.